This is Jody Tranna with Chapter 14 of Business Finance. In all of the chapters up to this point that we've covered, chapters 1 through 12, anytime you needed to discount cash flows, you were given the discount rate. Chapter 14 will help you figure out where that discount rate comes from. Just like in Chapter 12, where we learned how to break down the free cash flow and identify free cash flow for ourselves, in the same way, Chapter 14 helps us to identify the discount rate. We're going to look at the cost of equity, the cost of debt, and the weighted average cost of capital. Here's an example. You've seen this before for Sabre Electronics. We are evaluating whether to purchase specialty manufacturing equipment that costs $3 million. You were given cash flows that were uneven for years 1 through 5 and an initial cash outlay of $3 million for years 0. In Chapter 12, we learned how to calculate each one of these cash flow amounts. We called them free cash flow. But still, the discount rate was just given to you. In Chapter 14, we're going to learn how to calculate this discount rate. It's also called the weighted average cost of capital. It may seem to you like the weighted average cost of capital wouldn't change that much from one company to the next. But here's a map that shows that isn't true. The cost of financing wind energy, for an example, varies widely between the different members in the European Union. Here you can see there are some countries that are able to finance their wind power at rates of 5.7%. There are also some countries that are paying 11, 12%, even up to 13% for their weighted average cost of capital to cover wind power. It all relates to the balance between debt and equity, which is basically related to risk. Capital is a term that can be used in many different ways. Here we're referring to capital as the debt, the borrowed money, and the equity that are raised to support the business's operations and its growth. Nothing is free. As we can see, capital has an associated cost too. We can view the returns that investors expect to receive on the firm's stocks and bonds as the cost to the firm of attracting the capital that's used to fund the firm's investment in assets. The cost of equity plus the cost of debt equals the cost of capital. It's not quite that simple because we have a weighted average. We might have more equity than we have debt. We need to determine the cost of equity and how much equity we have compared to the cost of debt and how much debt that we have. That will determine our weighted average cost of capital. Let's put some numbers to it to make a little bit more sense. Let's say that we were covering our capital 80% by equity and 20% by debt. Historically, our cost of equity is going to be higher than our cost of debt. So a weighted average would put more weight on the larger cost of capital, the equity, than it would on the debt cost of capital. To calculate a company's weighted average cost of capital, we will go through these 3 steps. First, define the firm's capital structure. So right then we need to know how much debt and how much equity the company has. Second, we will estimate the cost of each source of financing. And third, we'll calculate a weighted average of the cost of capital from all of the sources of financing. Let's look at each step in more detail. Step number 1 is to define the firm's capital structure. That means determining exactly how much of the capital structure is from equity and how much of the capital structure is from debt. We'll identify a percentage, everything adds up to 100%, and those numbers we will use to calculate our weighted average cost of capital. The second step is to estimate the cost of each source of financing. Let's say that we know that it costs us 18% to service our equity, and it costs us 5% to service our debt. The next step is to calculate a weighted average cost of capital from all the sources of financing. We do this by multiplying our percentage of capital structure by our actual cost in step 2 to come up with our weighted average cost of capital. 80% times 18% is 14%. That's how much we expect our equity to cost us as a weighted average. Our debt at 20%, we expect that to have a 5% cost. So 20% times 5% is 1%. Our total weighted average cost of capital is 15%. Let's look at these 3 steps again for estimating the firm's weighted average cost of capital. This time we're going to use our template form. Here you can see that we have identified the market value of all the different kinds of capital that we have in our capital structure. We have $6 million of common stock, $2 million of preferred stock, $4 million of debt in bonds, which make up a total capital of $12 million. If we say that $12 million is 100% of our capital, which it is, we can identify which percentage each one of these different sources of capital have by taking their market value divided by the total capital. So common stock at $6 million divided by the total capital of $12 million equals 50%. The 50% indicates that of our capital structure weight, common stock carries half of our capital structure. The preferred stock is $2 million divided by $12 million, which is 16.67, and debt and bonds is twice that of preferred stock at 33.33%. All of these weights add up to 100%. The second step is to estimate the cost of each source of financing. Here you can see that before tax cost of common stock is 10.73%. This is calculated based on the dividends that we're paying. The preferred stock before tax cost is a little less, it's 8%. And our payments for bonds, this is calculated based on the coupon rate that we pay, is 6.32%. You'll notice that we also have a tax rate in column B. Our tax rate for this company is 30%. We need to know our tax rate because one type of capital is adjusted for taxes. You'll notice that common stock and preferred stock have the before tax cost the exact same as the after tax cost. But debts have a lower after tax cost than their before tax cost. The costs of bonds need to be adjusted for our taxes because the amount, the coupon rate that we pay out on bonds is interest, and it is a tax deductible amount. The dividends that we pay for common stock and preferred stock happen after our net income and are not a deduction for taxes. So we do need to adjust our bonds for our tax rate so that we can determine our after-tax cost. It's always lower than our before-tax cost because we get to write off that interest for tax purposes. The third and final step is to calculate a weighted average cost of capital from all sources of financing. Here you can see that we have taken our after-tax cost for common stock of 10.73% and we have applied a 50% weight to it. 50% times 10.73% is 5.36%. We do the same thing for preferred stock. 16.67% times 8% is 1.33%. And we take our after-tax cost for bonds, 4.42%, times our capital structure weight for bonds of 33.33% to come up with our weighted average cost of debt at 1.47. We add all of those up, and that is our weighted average cost of capital. It is also our discount rate. Take just a minute to think about what this means. When we look at future cash flows and we discount those cash flows back to a present value using a discount rate, what we are trying to do is to have a rate that covers all of our weighted average cost of capital. That means we want to make sure that our future cash flow can pay for our cost of capital, for our common stock, our preferred stock, and our coupon payments for our bonds. We also want to make sure to build in a profit, and that's why we look for a positive number for net present value, or a profitability index over 1, or an internal rate of return over the discount rate, because we're trying to make sure that we do cover all of our costs of capital, and we would also like to make a little bit of profit above that. So you have done this before. Back in Chapter 9, we practiced calculating the yield to maturity on a bond. This is how we calculate the cost of debt. Remember that you have different elements. The components of figuring out this problem are the bond par value, that's our future value. The coupon rate tells us our interest payment, so 5% coupon rate gives us a $50 interest payment. The period is 10 years for this particular bond. The market value, the cost is $900, that is the present value, and the company's tax rate is 30%. Calculating the cost of debt is a two-step process. We're going to start by using our financial calculator and plugging the components into our calculator. Or you can use the Excel formula, which is equals rate, and then plugging in the components. This will give us the before tax cost of debt. Using the calculator or the Excel formula, you will determine that the yield to maturity on this bond is 6.38%. We're not done yet because that is the before tax cost, and for weighted average cost of capital, we need to identify the average tax cost. We'll do that by deducting 30% of the 6.38 and getting a final after cost of debt of 4.47%. This is what it looks like when you calculate the cost of capital using a template. You'll have your par value, your market value, your coupon rate, how many periods there are per year. That helps you identify whether it's semi-annual or annual, and the total periods. You'll put in the tax rate, and the coupon payment will calculate based on the information that you've already entered to identify your yield to maturity of 6.38%. You need to be careful if you're calculating a semi-annual amount when you're using the template. Just be sure that you have your template calculations working correctly. This, you can see, calculates the annual yield to maturity and the cost of capital after taxes. Now let's talk about calculating the cost of common equity. There's two primary approaches to doing this. One you learned in Chapter 10, and the other one was discussed in Chapter 8. We will use and concentrate on the one from Chapter 10. Here is the equation to calculate the cost of common stock. You will take your dividend from last year, that's D0, and multiply it times 1 plus the growth rate. Divide that by the price from year 0, and then add the growth rate. You can see that our equation produced a cost of common stock of 14.75%. In the template, you'll be adding the market value, the stock dividend, and the dividend growth rate, and you'll use the equation to calculate the cost of capital. The cost of preferred stock is the same as the rate of return that investors require. So we use the calculation to determine the cost of preferred stock of taking the dividend on the preferred stock and dividing it by the price of the preferred stock. You'll see here that $1 is the dividend and $25 is the price. So we identify a 4% cost for preferred. Let's review the three-step process in estimating a firm's weighted average cost of capital. First, you define the firm's capital structure. Second, you estimate the cost of each source of financing. And third, you calculate a weighted average cost of capital from all sources of financing. When we define the firm's capital structure, we look at the market value of all common stock outstanding, preferred stock outstanding, and bonds. This is how much we could sell these for today. That helps us determine our true capital structure and not just the amount that we have on the books. We want to convert those market values of our different capital structure items into percentages so that we can see the percentage of our different capital items. Here you can see common stock is 50%, preferred stock is 17%, and bonds are 33%. Using the processes we have learned in previous chapters, we'll calculate our cost of bonds, of preferred stock, and of common stock. We need to make sure to adjust our after-tax costs for bonds, and then each one of these amounts in the column D will be multiplied times our capital structure weight in column B to identify our weighted average after-tax cost of capital.